A surge in residential sales and a robust profit headline. On the surface, Shang Properties begins mid-2026 with momentum. Revenue climbed nearly 10% this quarter, and net income advanced even faster, up almost a quarter from a year ago. Shareholder profit soared 30%. At first glance, the numbers signal confidence for one of the Philippines' leading luxury property developers. But beneath the headline figures, a more layered financial story emerges. Costs are rising faster than revenue, narrowing operating margins and applying pressure to the company's foundation. Cash exits the business more rapidly, even as debt appears reduced, because cash reserves fell faster than borrowings repaid. A closer look reveals how new towers are fueling revenue growth. Condominium income jumped by almost half, driven by ongoing projects like Lea by Shang, Shang Summit, and Bauhinia Residences. Progress is visible both in construction milestones and on Shang Properties' balance sheet. Meanwhile, a sharp rebound from its joint venture with Robinson's Land contributed significantly to this quarter's earnings, highlighting how revenue recognition can be timed ahead of actual cash collection. Leasing operations, centered around Shangri-La Plaza Mall and the Enterprise Center, offered steadier, recurring revenue, up slightly, thanks to higher occupancy and rental yields. Yet, even here, rising operating costs outpaced modest revenue growth, signaling that no segment is truly insulated from inflationary pressures. The hotel business, anchored by Shangri-La The Fort, lost some momentum, with revenue slipping and costs climbing. Hotel margins contracted, raising questions about sustainability as future operational gains become harder to secure. As expenses rose faster than sales, Shang Properties' gross and operating margins receded. Shareholder gains were propelled mainly by improved joint venture profits and reduced finance costs rather than core operations. This dynamic illustrates the unique economics of property development. Profits often precede actual cash flows. Most striking, however, is the widening gap between reported profit and cash generation. Net income grew, but cash from operations shrank. Construction, advances to suppliers, and investments in new properties drew down cash reserves, funding future growth but consuming liquidity today. Debt was paid down, yet net debt increased, as reductions in cash outweighed repayments. No signs point to immediate financial distress. Shang Properties retains a conservative debt position and maintains sufficient liquidity. Yet the company now faces a pivotal challenge. How quickly can profit and construction progress translate into cash receipts before further investment requires fresh capital? For investors and analysts, the message is clear. Shang Properties stands at a crossroads, expanding its footprint while navigating tighter margins and cash flow constraints. The second half of the year will hinge not only on rising towers, but on converting progress into tangible collections and solidifying long-term financial resilience.